why is the price of gold rising? What's going on in the economy?
Right. It's sort of a two-part answer, Robert. One is exactly as you put it. Why is gold going up? What's going on? What's the basis for predicting $15,000 an ounce by 2025, which I do. But then also, well, what does it really mean? Is that you said it's not a good thing, and I agree. It's not a good thing for the economy. It's not a good thing for most Americans. If you have gold, you can pat yourself on the back and say, "Yeah, I made a lot of money on gold," but that might be in a world where you're losing a lot of money on other things, and you need to be alert to the overall economic picture. So let's take this one at a time. The gold $15,000 an ounce. It comes out of three different analyses that actually don't correlate to each other. In other words, you do it one way, you get a number. You do it another way, you get a number. You do it a third way, you get a number. It was interesting that they all came out not exactly to the penny, but very close to that $15,000 number. So the first way to do it is just, it's a little bit of technical analysis, not overly technical. We're in the third great bull market in gold in history. When I say in history, you're like, well, gee, history is a long time. How come this is only the third bull market? Well, the answer is for almost all of history up until 1971, gold was money. So you didn't have bull markets or bear markets. It was just gold. That was the money. And you thought about it by weight. You say, well, I'll give you an ounce of gold for this property, or I'll give you, a quarter ounce for, some food or groceries or whatever. So you thought about gold by weight. It was money, constant store value. So it's really only since 1971 when Nixon suspended redemption of dollars for gold by our foreign trading partners, that gold just went its own way, detached from the dollar. So the dollar would do what it was going to do, and gold had its own market and still does. The first great bull market was 1971 to 1980, and gold went up over 2,000%, from $35 an ounce to $800 an ounce in January 1980. Then there was like a long, drawn out, almost 20-year bear market from 1980 to 1999, and gold dropped down to around 250. So it went from the 800 level down to 250. The second great bull market was from 1999 to 2011. August 2011, gold went from $250 an ounce to $1,900 an ounce. That was an almost 700% gain. Then the second bear market, August 2011 to December 2015. The third bull market, I can give you the exact date, December 16th, 2015. Gold hit $1,050 an ounce. That was the bottom of the second bear market I described, a pretty steep fall from the 1900 level. But you could tell it was the bottom. You say, well, how do you know that? I had a conversation with our friend Jim Rogers, one of the greatest traders in general, and certainly one of the greatest commodity traders of all time. And this was before that market bottom, when it was still going down. And I said, Jim, we were down in the Dominican Republic. I said, Jim, are you buying gold? And he said, no. He said, I've got gold. I'm keeping the gold I have. I'm not buying more right now because it hasn't hit bottom. And then he gave me one of the best pieces of advice I've ever had. He said, Jim, nothing goes from here to the moon without a 50% drawdown along the way. It'll get there, but it'll go up, down 50%, and then back up for the really big, sort of hyperbolic price move. We said, you have to expect that. It's true of all commodities. Well, taking that advice, I then, looked at the charts. Well, starting 1900, if you say, okay, it was 250, it was 1999. 1900 was August 2011. So there was that gain, 250 to 1900. So there was that gain of $1,650 an ounce of gain. Take half of that, that's 825. So take 1900 minus 825, and guess where you come out? You come out right at 1075. And so when I saw 1050, I said, bingo, there's the 50% drawdown. It's exactly what Jim Rogers said would happen. That's the bottom. And it's up about 50% from there. Now, it's been a little bit higher than that, but it's up about 50% from there. So there's your third bull market. But here's the point, Robert. If the first bull market was up 2,000%, and the second bull market was up 700%. If you just take the average of those two, you don't have to pick the higher of the two. You don't have to go crazy or say it'll be bigger than ever. It could be, but you don't have to do that. If you just take the average of those two, you would come up with a number around 1,400% gain from from the 1050. Well, that would put you at almost $15,000 an ounce. So in other words, and the same time period, the first bull market was 8 years. 9 years. The second bull market was 12 years. Just take the average, you get 10 and a half years. So from December 2015, just using the averages, not anything crazy, 10 and a half years up, 1,500%, bingo, puts you at $15,000 an ounce in 2025. And by the way, don't wait. If you agree with that analysis, and there's more to back it up, don't wait until 2025. People say, oh, okay, well, it's going to be $15,000 an ounce. I'll go out and get it in 2024, I'll catch the wave. No, it's a long way between here and 1,500. I mean, you got to get to 3,000, 4,000, 5,000, 6,000, 7,000, et cetera. You got a long way to go to 15,000. So why not get the gold now, which I do recommend, and then enjoy all those profits? Don't wait to the end, because it could happen. There could be like a little spike at the end.
I don't own paper. I have nothing that's a derivative. I know I have 90% in hard assets, gold, silver, real estate, things I control. And when I have gold, we bought the gold mine. So we owned the whole damn thing. And then we sold one. But then when I talk to other guys who are more paper asset guys, like financial planners and all that, and there's this one famous guy, I won't mention his name on our air because he's always on our program. He says, you got to buy U.S. Treasuries. And I'm going, what? And so with your background, with your banking background and all that, or bonds, should I say, I don't know what you call those things. I don't like them. When somebody is being told by either a financial planner or some expert, say, to buy bonds, treasuries, and all that, because they're safer and all that, what do you say?
I think you have to segregate, first of all, when you're buying bonds, between long-term bonds and short-term bonds. The long duration bonds, the idea that you would subject yourself to negative real interest rates is stupid. You forego consumption in favor of somebody else, and you take the credit risk. And in return for that, they give you back less money than you gave them. This is not a force of nature. It takes Congress to do this, right? Short-term debt is something very different. It's liquidity. I have had periods of time in my life, Robert, when I had no cash. And I've had periods of time in my life when I had a lot of cash. And I was happier and slept better during periods of time when I had a lot of cash. I consider cash to be a soporific, and I like to sleep. From the point of view of a financial plan, cash, liquidity, gives you the means and might give you the courage to take advantage of a circumstance where there was a liquidity shortage. Going back to 2008, late 2008, 2009, were very good investing periods for me because of the liquidity crisis. I maintained a lot of liquidity going into that, and I was able to buy assets because I had the ability, and because I had the ability, I had the courage. The consequence of that is that ever since, I've been running fairly high cash balances, even though the cash guaranteed diminished returns in the near term on my purchasing power. I consider the negative real interest rate that I suffer to be an option premium, because the cash gives me the tools and the courage to take advantage of any future crisis in confidence or crisis in liquidity. And I actually think that a crisis, while not a certainty, is a probability. So I understand that on my cash holdings, I'm losing 4 or 5% a year in purchasing power. But I think the circumstance might come about in the next 2 or 3 years where the consequence of having that cash is 50, 60, or 100% returns on capital employed by deploying that cash.
So let me poke holes in my theory. Like I said, that little Vietnamese woman in 72, and she wouldn't sell me the gold at a discount. I couldn't believe that. I was just asking for $5 discount. She wouldn't do it. I saw the Vietnamese running with a gold leaf, not US dollars. And then I go to Hong Kong and I buy my first Krugerrand. I still have that Krugerrand. I paid $50 for it. It's in Switzerland now, but that Krugerrand is now worth approximately $1,900. So I'm always saying to Kim, I want you to poke holes in my logic. I don't save cash. I save gold and silver. And if I ever need the cash, I think gold and silver are liquid. Is that erroneous or?
No, gold and silver are extremely liquid. They're one of the most liquid asset classes in the world. I'm a lender, and I love lending against gold and silver, particularly gold and silver where I control rather than the borrower controlling the collateral. They're enormously liquid. I live in a circumstance that, even given the problems that we face today, is substantially more civilized, more benevolent than the young Vietnamese woman who, the choices that she had in terms of her savings and her business were limited compared to the choices that you and I exhibit. Also, because of the asset classes that I deploy capital into, include what you would call derivatives, what I would call securities, having access to cash to access securities markets without having to sell my gold or silver is convenient for me. Interestingly, because as an example, I'm the largest shareholder of Sprott, a large financial services concern which is built around gold or silver. A financial planner would tell me that I didn't need to own any gold, that my life was already leveraged to gold. But again, owning physical gold makes me sleep better.
Hi, everyone. I'm Kim Kiyosaki, co-host of the Rich Dad Radio Show. And I want to thank today's sponsor, our friends at Gold Alliance. We should all be concerned about high inflation, a looming recession, the very troubled banking system, and out-of-control spending in Washington. And the fact is, during every major crisis in U.S. history, many of those who failed to prepare watched their savings, investments, and retirement funds plummet, while others with the foresight to own gold helped preserve their wealth and purchasing power. Now, we're facing several major crises at once, and we may soon face even more economic turmoil. So please don't wait. Consider gold and put yourself on the road to financial peace of mind. The new free 2023 Gold Guide from our friends at Gold Alliance can show you how. Just visit www.freegoldguide.com/Robert or call 1-800-473-4585. Republican governor and conservative commentator Mike Huckabee says Gold Alliance is the only gold provider he recommends to his friends and family. Please visit freegoldguide.com/Robert or call now at 1-800-473-4585. Thank you.
Feeling powerless over current events and your financial future? Financial freedom is your freedom. Robert Kiyosaki is the best-selling author of Rich Dad, Poor Dad. Over 40 million people have taken Robert's advice. Now it's your turn. Attend Robert's free virtual wealth building event. Claim your free access now at richdadfree.com. Don't wait, access is limited. Go to richdadfree.com. That's richdadfree.com.
This is bigger than even I had thought. When you have 200 countries from around the world on top of the Belt Road Initiative, on top of gold being reclassified Tier 1, on top of all the central banks repatriating their gold, now the IMF wants a new standard. So now I'm convinced something's going on. was originally built to offset risk, where if I own 1,000 ounces of gold in my warehouse, I'll sell 1,000 ounces on paper on COMEX. So if the price in my warehouse drops by $100, I'm not down $100,000 because what I sold short on COMEX goes up commensurate. It allows me to offset my risk, to be market neutral. Or a farmer who plants a field of grain in April can sell the future production to the baker in October to make bread. He wants the wheat. The farmer doesn't have to go the whole growing season with the uncertainty of the weather and the crop and all that stuff. It's just a way to offset risk by people who deal in commodities. Well, it's turned into a casino for sure. But what happened in 2020 was this group, the others, started to drain the market, the COMEX market of physical supply. When no one ever took possession, they took off in 1 year in 2020 more silver than we've seen in a typical decade being removed, and more gold that year than the Bank of Japan has in its official holdings. So now you have the most private, the most well-funded, well-informed private investors doing the exact same thing that the commercial banks and the central banks have been doing, and that is massively accumulating metal and taking possession of it.
And that was my question. And they're taking possession. They're not just buying it. They're taking possession. Okay.
Right.
Yeah,
So
when we get to 2022, we'll see just how much they're really doing. I'm sorry, Robert.
But this is the point where Kim and I take possession. You know, we don't leave it in those fake ETFs and stuff.
Well, or on the COMEX exchange in 1,000-ounce silver bars or 100-ounce gold bars.
Yeah.
And I think that's a big deal. You know, Doug Casey has always made, he has a lot of one-liners and comments that I've always got a lot out of. One of them is that gold and silver are the only assets on the planet that are not simultaneously someone else's liability. So in a world where counterparty risk could become accentuated or come into play, the removal of counterparty risk by taking possession of this metal is very illuminating. So here we are in 2020, and all of a sudden now, you know, you see all of these things that are happening. The IMF asking for a new system, gold being reclassified tier 1, the central banks repatriating their gold. All of these things are happening. The banks copiously buying gold, and nobody knows about any of it. 2021 comes around and we see Russia and Turkey and India and Poland and China and Kazakhstan and Hungary and Thailand and Japan and Brazil and the Czech Republic and Turkey. They're all buying gold. No one's talking about it. Why? I don't get it. I mean, you got half of the world's central banks copiously accumulating gold and nobody is talking about it. I watched Fox News. Where is it? Sorry?
Please, what Andy's saying, they're not just buying it. They're taking delivery of it. Right. And that is a very, 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 very big difference. I'm going to be talking about gold and what's happening.
Nice to see you, Robert. Thanks for having me on.
Thank you. You made I was watching with Danielle, one of my favorite people on Stansberry. You were talking about a 40% decline in reserves in the gold industry. What does that mean?
Well, that means the gold in the ground that's been delineated by exploration drilling. And the industry has done an exceptional job over the last half a dozen years of harvesting returns from their existing mining assets. What they haven't done is reinvest back in exploration and development, because at the end of the day, a mining company is a collection of finite life assets. Every day that we mine an ounce of gold, we die a little bit unless we're reinvesting back into exploration. And that hasn't happened because there was quite a party 10 years ago. Post the credit crisis, gold rode to over $1,900 an ounce. Copper was reaching new highs at the time, and the industry was investing in significant new mine capacity, but they strapped on a lot of debt doing that, and the input costs escalated dramatically because of the rush to invest in new capacity. There was finite resources available to do that, and so we saw inflation in labor costs and input costs generally, and that undermined the leverage proposition that investors were looking for in gold stocks, and investors stayed away. And so the mining industry said, well, okay, we have to deleverage. We have to harvest the returns we promised on these assets. So they went through a half a dozen years of doing that very, very well. The industry is at net zero debt now. So they've done a good job of repairing their balance sheets. But what they didn't do is replace what they're depleting. And that's why we find ourselves in this kind of existential crisis in the gold industry right now.
Right. So the thing I was laughing about with David and all this, they have these junior miners and exploratory companies, and then you have the majors. and the majors are like Barrick and those characters. But they need the juniors to go out there and dig around in the dirt. So that's exactly what I was doing. I was digging around in the dirt, and I was all over the world looking for that stuff. I was in Arequipa in Peru or something like that, and it's really an education. So all you guys with your 401ks, grow up. I mean, you haven't seen nothing yet. So anyway, what's happening to the juniors then if the majors can't get more reserves?
Well, selectively, they've actually been able to access capital markets now. That wasn't the case a couple of years ago. They went through a nuclear winter as the seniors focused on harvesting, cash flows from their existing assets. They just weren't putting money to work with the juniors. They weren't exploring in any meaningful way, and the capital markets ignored the juniors. But the juniors are actually starting to raise capital now, and they're doing that from a couple places: traditional sources, the equity capital markets, selectively, but also the established producers are effectively outsourcing their grassroots exploration to the juniors. They're putting capital to work within the juniors, taking tolled investments in them, so they actually start to put some capital to work. And the seniors are taking more of a portfolio approach towards that. They're deploying capital across 15, 20, 30 names within junior space, small amounts of capital, because the success ratio is so low in the junior space. It's almost like winning a lottery when you actually find something. And because of that high risk ratio, you're deploying that capital and spreading it around, diversifying. So the juniors are starting to spend more capital. They're starting to get more traction in the capital markets. And inevitably what will happen is the established producers will have to start to take the juniors out that are successful, and they find something meaningful, economic, large enough for the seniors to actually deploy capital towards. So I say selectively, you're going to start to see some M&A in the junior space.
So the juniors are the reason I traveled the world was I was looking for gold. And we finally found a gold mine in China, and it became a major. And then the Chinese said, thank you.
Yeah.
You don't teach that in business school. What did they say when they say thank you? We just took your gold mine.
Yeah.
And I'm going, what? And so today, China's one of the biggest net gold producers. And it's the gold mine we found in China. So anyway, I really enjoy this whole world, but I'd rather stick with real estate. Anyway, so what's happening if it's a 40% decline in reserves? How does that affect the price? And what does that mean for the average guy with their 401k or IRA, with their gold IRA stuff?
It's a commodity like anything else. It's demand supply driven. So the price action we're enjoying right now in gold and have over the last couple of years and likely to enjoy going forward is being driven by two factors. One is this declining supply. So it's a remarkable inelasticity of supply to price. Even as the gold price has been going up, the industry can't just flick a switch and add more supply. The lead times in new production are long, sometimes decades, to bring new mines up into productive capacity. But the demand side of it is also very, very constructive because we're in a lower for longer interest rate environment. We're actually experiencing nominal rates that are negative in some cases. And on a real basis, for sure, given where inflation is, we have negative real interest rates on sovereign debt. So there's no opportunity cost to owning gold today. It is the one financial instrument, monetary instrument, that doesn't yield anything. But when sovereign debt is yielding negative on real basis, gold is not a great place to park your capital, and it's very finite in quantity. So it's really driving capital flows into gold, and for that matter, into cryptocurrencies, which is being perceived as a store of value like gold, as an alternative to gold, is the undermining of fiat currencies that's going on with printing, with reckless abandon by central banks on a coordinated basis globally, debasing their currencies to inflate the economies and debase also the debt. The massive amounts of sovereign debt that's been strapped on is unprecedented. And the only way that these governments can hope to repay the debt is basically to debase the debt. And the way to debase the debt is to debase the underlying currencies.
In times of black swan, whether it's the dollar going up or crashing down, or who knows, World War III, we could be on the brink of that. What you want to own is you want to own an asset that has no counterparty risk, right, Robert? And we talked about those green, and not only that, but let's think about it. Most people that own toilet paper, they don't even own the physical toilet paper. They own the electronic toilet paper that's a liability of their bank, which we know can go bust. It's even worse, right? So for heaven's sakes, if you don't own if you don't have a portion of your net worth that's in an asset that has no counterparty risk, and obviously what I'm talking about there is gold, Bitcoin, maybe silver, something like that.
And this kind of toilet paper, because I actually do own a lot of real toilet paper, George, because there's no counterparty risk to it. And I'm so full of shit, I'll probably use it.
That's good.
So the best investment.
Main takeaway for the audience.
They'll say from George Gammon.
Risk.
They'll say from George Gammon and Robert Kiyosaki, your best investment is get some Charmin toilet paper. No counterparty risk. Get it while you can. Hey, George, thanks for the years and years of friendship and wisdom. I appreciate it. And then for all you listening, we'll be right back with a final wrap up on the Rich Dad Radio Show. So, George, thank you.
Hi, everyone. I'm Kim Kiyosaki, co-host of the Rich Dad Radio Show. And I want to thank today's sponsor, our friends at Gold Alliance. You know, we should all be concerned about high inflation, a looming recession, the very troubled banking system, and out-of-control spending in Washington. And the fact is, during every major crisis in U.S. history, many of those who failed to prepare watch their savings, investments, and retirement funds plummet, while others with the foresight to own gold help preserve their wealth and purchasing power. Now, we're facing several major crises at once, and we may soon face even more economic turmoil. So please don't wait. Consider gold and put yourself on the road to financial peace of mind. The new free 2023 Gold Guide from our friends at Gold Alliance can show you how. Just visit www.freegoldguide.com/Robert or call 1-800-473-4585. Republican governor and conservative commentator Mike Huckabee says Gold Alliance is the only gold provider he recommends to his friends and family. Please visit freegoldguide.com/Robert or call now at 1-800-473-4585. Thank you.
For the last 16 years, about 17 years, Brazil, Russia, India, China, South Africa, they've all been hoarding the Earth's gold in preparation for introducing a new gold-backed programmable central bank digital currency. So a lot of your wonderful listeners, they listen to your show where you talk about buying precious metals, and I'm sure many of them do buy precious metals and many of them don't. Meanwhile, Brazil, Russia, India, China, South Africa, they've been hoarding the Earth's gold in preparation to introduce a gold-backed programmable central bank digital currency. Don't believe me, folks, look it up. It'll be based in Shanghai, China. It's called the New Development Bank, and this will be a new financial system. And now there's BRICS 11. You have Saudi Arabia joining. You have Dubai joining. So what's happening is the U.S. dollar, which was only tethered to this thing called the petrodollar beginning in the early 1970s, Saudi Arabia has now left the petrodollar. So, folks, this just in, we have a petrodollar with no petro. So we're about ready to see the collapse of the dollar, and only people like yourself and the listeners of your show who've decided to take your advice and to acquire precious metals are going to be prepared for it. And so I just encourage everybody out there, if you're listening right now, before your dollars disappear and evaporate into nothingness, I would highly recommend that you schedule a consultation with a precious metals dealer. And Robert, I know you vetted your precious metals dealer of choice, but everybody out there, it's very important that we take action. And I don't make a commission to encourage people to go to your precious metals dealer, but I would recommend that everybody takes action. And I believe that link is freedomgold.com/Robert. So freedomgoldguide.com/Robert. I don't make any money for telling you that, folks, but it's super important that you take action.
Well, that's a long way of good introduction there, Clay.
Yeah.
Anyway, the point here is this: it's people are addicted to this here.
Yeah.
And I'm old enough to know that this here, and in 1972, I was flying this here in Vietnam. And I killed a lot of people, I'm afraid, but that was our job. And that was when 71 was when Nixon took the dollar off the gold standard. So 72, I'm flying this thing in Vietnam, and we don't know what gold is. It was illegal for Americans to own gold in 72. So my co-pilot and I flew behind enemy lines through the only gold mine we knew of, the NVA, North Vietnamese Army, has overrun the gold mine already. And we had to go try and buy gold. So this is what happens. So this here is an ounce of gold.
Yep.
This here is a US dollar. Back in 1972, when I was flying behind enemy lines, this thing cost 35 of these. So this piece of gold here costs 35 of these. Today, this thing here costs 2,100 of these. Now, did this get bigger or did this get more worthless? And what's happening to most people, Clay, as you know, they'd rather have this than this. And the one more thing is this here is a silver eagle, a silver Indian head nickel. It's only 35 bucks. Everybody in the world that I know of, kids can afford 35 bucks. My question to the world is this. This is 2023. This is 35 of these. This 35.
Right.
What will happen in 10 years? How many of these will it take to buy one of these? That's the question.
Well, Robert, I wanted to say this. When you were serving in Vietnam, actually, when you returned from Vietnam, you had a lot of these hippies that were spitting on you and throwing eggs at you and saying horrible things about you. Those are now today's professors. So what's happening is these professors are teaching our kids. So, and this is my story, but in 2000-ish, when I first discovered your book, you said you have to go from being an employee to self-employed, to being a business owner, to becoming an investor. So I'm working at Applebee's, Target, and DirecTV, and everybody I know says to me, what are you doing? You got 3 jobs? What are you doing? I said, and I'm starting a company called DJConnection.com, which I don't own, but it grew to be one of the nation's largest wedding entertainment companies. So in 2005, because I followed your advice, and I also read Rich Dad, Poor Dad, the whole series you had, I read pretty much every book you had, I sat down with a buddy of mine who owned a bank. And I said, sir, you own a bank. What should I be doing with my money? Because I'm making about $150 per show. We're doing 4,000 shows a year. What should I do? And he said, you need to take a quarter of your money and buy precious metals and take a quarter of your money and buy real estate from emotional people. I said, emotional people? He said, people that are going through a transition, see if you can buy their house on a discount. Look for tall grass. And so I started doing that. And this is full disclosure. When I started buying gold and silver, it was like $500 an ounce. And what I've done is I've taken that and I've protected it, and you keep it in a safe place, these sorts of things. And now I look like a financial genius to a lot of my peers and people my age, because they said, you've been buying gold since 2005? Isn't it $2,000 an ounce? I go, oh yeah. So I just encourage everybody out there, if you think you can't afford the $35 to buy some silver, you really need to take action, because what's going to happen is once Brazil, Russia, India, China, South Africa, once they can conduct transactions without using the dollar system, okay, this is called BRICS Pay. Everyone needs to look it up. Just type it in, BRICS Pay, BRICS Pay. Once they can conduct transactions no longer using the US dollar, you're going to see this thing called dedollarization. And that's where they're going to no longer acknowledge the value of our dollar. So we're in a country where we import everything, our food, our clothing, our electronics, and we export dollars in exchange for the items that we want. And we're going to find ourselves in a world where we want to import everything and nobody wants our fake currency. And that's what's happening right now. And so Xi and Putin, they just teamed up 7 days ago to announce, the New York Times has reported this, Xi and Putin have announced they're going to be ushering in a new world order. So I just want to encourage people, if you haven't bought precious metals, you need to do it now.
Well, that's a long way of saying it. Anyway,
yeah.
What do you really think? Hey, my question here is this.
This podcast is a presentation of Rich Dad Media Network.